Hello, everyone. Carl Weiss at Fairway Independent Mortgage Corporation here today with you. And we again have our esteemed guest, Mr. Clayton Janson, Certified Financial Planner, joining us for another round of financial literacy, where we're going to jump into a few different categories here and really start, I think, expanding some of the knowledge base and really helping people advance through some of the different thought processes as it comes to money and investing. So welcome, sir. How are you doing?
I'm doing good. Love that beard.
Well, thank you. It's short for this planet, but it'll be good. It's October. So, uh, last uh, segments, we've had a few opportunities to jump into some different concepts. And really what we did is we started off with kind of budgeting 101, and we took people through that process and gave them some tools where they could, self-assess and go through the budgeting process themselves and come up with some numbers and kind of allocate maybe some of their income and expenses down the budgeting line. And then we expanded into the asset class arena, and we gave people some ideas of really kind of I guess we'd call them the three major asset classes as it relates to um, bonds, fixed income, the equity side of the world, which is more the ownership piece, and then the additional items that we have in the extras category, which would be things I think you exclaimed more like precious metals, cryptocurrencies, currencies themselves. Have I encapsulated that fairly well?
That was perfect. Yeah.
Okay.
Stocks and fixed income and alternatives. That's right.
Alternatives, great. And so I thought where we also kind of left off was we've given people sort of a conceptual idea of money in terms of buckets, right? And you and I have both used these analogies of buckets in the past, where we've got a bucket of cash, and we would use some of that short-term money or that short-term bucket to cover immediate expenses, unforeseen expenses, even. And that might equate, I think most people would agree, 6 to 9 months of income into that category, that bucket. And that's going to be a very low volatility. That's going to be a savings type account that earns, very little and also has the risk of not fluctuating in value, correct?
That's right.
And then we've talked, your next bucket that we really talked about was actually the long-term bucket, the retirement savings, uh, the longest term bucket that we have of the three. And we'll jump into some of that, I think, today too, as it relates to, employer sponsored plans, retirement plans, 401ks, 403bs, whatever's offered through your employer, as well as, IRAs and things along those lines, in case you don't have an employer sponsored plan, but you would still like to plan for some retirement funds. And then, of course, we've got the midterm bucket, which is sort of the 2 to 10 year bucket that would be for planned expenses. And, not of retirement nature, but also not emergency based, right? Um, and you've kind of alluded to some of the things that go along with this planning piece, as we've kind of gone up this um, conceptual ladder in terms of education, experience, and maybe even the desire of more return up the ladder from the safest, instruments out there, the savings accounts, money market funds, things like that, up into the investment strategy world, right? And one of the key things that you mentioned that I thought would just be fantastic for you to take us through is a risk assessment, so that people know, like, where am I on this continuum and what's appropriate for me or not appropriate for me.
That would be great. Let's do that.
Cool. Love it.
Should I jump in and give us a tour of
Yeah,
the new?
jump in, walk us around, let us test drive this thing and see what we've got.
All
And
right. So
for those of you that are joining us, through audio only, I will put a link down in the description so that you can open this up and revisit this, and we'll do it along with you, um, uh, audio wise. And if you're able to watch it, then we'll just take you right through it now.
Yep.
or
And
Clayton.
before I bring this up on the screen, Carl, thanks for the great intro and background. Risk tolerance used to be 20 years ago. It used to be something that I think people only thought it took 3 or 4 or 5 questions to figure out. And now, what I'm about to walk you through is really an up to date version of that because we know so much more about markets, but we also, more importantly, know so much more about people, right? And just kind of who we are psychologically and how our behaviors impact decisions that we make financially. So I'm excited to share this with you. So let me grab my screen here and let me know when you see that risk survey intro page.
I see it.
All right. As Carl mentioned, we'll definitely provide that link below for anybody that wants to jump in and take this assessment. And I'll start by saying it's totally free. Please use it. It's open at your leisure. Forward it to a friend or a family member. And I think what you'll see at the end, it gives you a nice, just kind of a nice broad picture of what it looks like by your answers on how you should be investing, and just kind of a good place to jump in and get started. So I'm just going to kind of build one for myself. I'm just going to put my name in here. We'll put some basic details, nothing fancy, and my email address, right? In order to kind of unlock, right, the questionnaire. So we're just going to click Take Risk Survey. And so once you click on it, it starts just kind of giving you the background on building this risk profile. I'm going to get into the 3Ds here in a second. But it should only take about 5 minutes. Now, if it takes you a little bit longer, that's totally fine. There's no time limit. It's just trying to give you an idea about how long it should take. But really, what I was just mentioning is older risk questionnaires used to really just focus on tolerance. So you're still going to hear that word a lot. And Carl and I use that word pretty often, risk tolerance. What's your kind of just comfort zone, your willingness to take risk. But what I love about our new risk just assessment tools, this one in particular, it really does focus on 3 areas. That's where they get the 3D part. Capacity is your ability to take risk based on your goals and your timeline. And then it also adds composure, which is more about the volatility and change and your psychological comfort with that. So
Hmm.
you're going to see these different areas. We're going to go through the questions right now. And Carl and I can kind of go back and forth on what some of these questions mean and why they might be important to you. Because, with any investment, it's not just what's the rate of return. It's also, how are you going to feel about it? Does it meet your goals? Is it going to be the kind of thing that you're going to be able to stick with? Because Carl, I'm sure you've seen this before. I've seen clients many times get into an investment just based on the potential for the return, and then they get out of it at the sign of the first issue when it starts to maybe pull back, and then they never get to benefit from that actual investment. And so this tool will help you assess if you're even going in the right direction. All right, so risk capacity, again, this is to gauge your ability to take risk, but it's based on your age and the level of wealth that you've already built and just kind of your general understanding. So we'll get right into it with these questions. First question right out of the box: what is your number one investment goal? Accumulation, maintenance of your money, or distribution? And all 3 of those things are totally different. If you're young, you're very likely to start accumulating funds, right? You're building your investments. If you're about to be retired, you're in a lot of cases in the distribution mode, right? You're looking for that income stream. And then the maintenance mode might be either somewhere in between here and there, or maybe you're bridging a gap between spots, but maybe you just want to maintain, right? Just maintain that wealth. All right, so we're going to put accumulation here for this one, Carl. I'm going to let Carl pick the next one, right? Approximately how many years do you expect to continue to invest your assets in the stock market? What do you think, Carl? If we're in the accumulation phase, what should we pick?
I think for general purposes of our audience, maybe that 11 to 15 years, but
Yep,
I have no problem with the 6 to 10 either, because that kind of matches our bucket that we might be talking about. But those, I think, those would be great. This is a fairly long piece of time for people uh, to see what kind of output we're going to get from this.
yep,
And I'm glad to see that, quite honestly, as you mentioned, uh, when I was licensed through the NASD, 1,000 years ago, we had basically one component of this tool, right?
that's right.
And you're absolutely right, because I still refer to it as the tolerance side of the world, because that's really how we refer to it, as a risk tolerance. But just as you stated, plenty of people, has been my experience, that think they're very, very aggressive until something dips 3%.
That's right.
And then
Yep.
we find out maybe it
We're
wasn't,
not that aggressive.
maybe we're a little more moderate.
Moderate aggressive. Yeah. Great. Great. No, that's so true. All right. So I notice how I just clicked the previous button, so we can go back if we just want to maybe kind of see, get to the next question, or just maybe we had a second thought. So that's always nice too. So I like your idea. Let's match it up with that midterm bucket. That's a great way to kind of bridge the understanding of how this should be invested. How secure is your current and future income? So let's just take a general stance that most folks that might be watching this have a job, and just we're just going to kind of group that, and they're going to say, "Hey, my income is secure." But notice how if you just have a different situation, that's totally fine. Where before, as Carl and I both have mentioned already, prior questionnaires never would have asked that. They
No.
never would have asked, "How secure is your income?" But how important is that? I mean, if you just got let go from a job, you just got right, maybe a severance package, or you got laid off. That might affect how your investment should be invested, right? You might start needing to pull from them right away, so you might be going into a totally different risk, situation. So we're going to go with my income is secure on this one.
Yeah, I love that because, we have clients all over the country, and a lot of the people that work in the Midwest and the East Coast for in a lot of the unions, they're seasonal, essentially seasonal employees, and they should regain employment every year, and it's typical
Good.
they do.
Yep.
But if they don't feel secure about the prospect of returning to work, that definitely plays into this, doesn't it?
Yeah, that's right. That's right. Or maybe you feel moderately secure. Yeah. So you can
Right.
kind of say, I'm pretty secure, but maybe not like steady. Like you said, it's a seasonal thing. All right. Next question. How are you able to handle financial emergencies? Now, the key word here on this next part is without drawing from your long term investments. What do you think we should put on this one, Carl? I don't have an emergency fund. I have savings for a rainy day. I have savings to weather most emergencies, or I feel ready for anything that comes my way.
I feel like if they've listened to some of our previous conversations, it would be at least the I have savings to weather most emergencies. If not, I feel ready for anything that comes my way because 6 to 9 months of
Yeah.
actual income to cover expenses should at least weather most,
Agreed.
emergencies.
Yeah. Let's go with that. Love it. How long do you plan on drawing from your investment accounts? Now, this one, if we're thinking back to our 2 to 10 year midterm bucket, it might only be 1 to 10 or 11 to 20, right? That might be kind of our situation that we're thinking. If you were answering this question, as Carl mentioned earlier, in the retirement sense with that long term bucket, you might put 30 years or more, right? As kind of like, how long do you plan on drawing from it? So I would say we lean towards this 1 to 10 year, Carl, just so we've got something that kind of matches up with that 2 to 10 year bucket. What do you think?
That sounds great.
Okay. How would you describe your investment knowledge? Now, this one is going to range for pretty much everybody, right? We've got clients of all experiences here, and there's no wrong answer. I think, again, it does, though, correlate to most of our folks that have had a lot of experience in investments tend to have more comfort taking a little bit more risk. So again, it's just drawing that parallel between those worlds of experience and risk. But Carl, what do you think we should put here? How would you describe your investment knowledge?
So I think if we maybe kind of pick that middle of the road, that some knowledge and experience might give us, you know, um, we've got a basis of understanding, but we may be newer to,
Yep.
we may have a lot of knowledge, but not a ton of experience. So having some might be a good place to start for most people that are certainly taking this self-assessment tool maybe for the first time on their own.
Yep. Good point. Yep. And don't be shy. If you feel differently from your answer when you're going through this or a question you're like this, it's
Hmm.
not worth, right, trying to game the system. Just put your most honest answer down, and I think you'll get the best results at the end. How often will you be contributing to this account? I won't be able to contribute. I'll contribute it once a year or so. I'll contribute quarterly on average, or I'll contribute at least once per month. I would think, Carl, for the folks that we're trying to maybe reach out to, maybe one of these bottom three answers, but should we just kind of take the average in the middle and contribute quarterly just to kind of be looking for that? Hey, I'm not necessarily saving into my savings account. I've got that built up emergency fund. I'm already saving into my 401k probably with every paycheck, right? Payroll deposit. Does quarterly make
I
some
think
sense for this one?
absolutely. I think quarterly is great.
Excellent. All right. So we just completed the first series of questions on capacity, risk capacity, right? And this again was based on your age and right your comfort, right, with some of those knowledge and experience questions. So we already are getting a sense as to what our risk score might be. So let me just kind of pause here and just recognize that we are scoring a 63, right, risk capacity. So think of this number as how comfortable. Now, we're not through with this questionnaire, right? We have two other sections to go through. So let me just kind of reiterate that. This is just part one of three. But this would already say we would be comfortable leaning into stocks about 63% of our funds into stocks,
Hmm,
into the market. Or another way to think about that would be 37% to be safer in that midterm bucket, right? So that
gotcha.
2 to 10 year bucket. So this is definitely leaning in 63% into stocks. But mark my words here, we're not through yet, right? We can see down here, step two of three is next, right? Which is gauging our risk tolerance. But any thoughts here, Carl, about the 63 so far?
No, I love it. And it's great to have sort of a what does the 63 relate to, right?
Yep. Yep, exactly. All right, let's jump into the risk tolerance. All right, so again, this is where that volatility part comes in, right? So we're going to probably see some questions with a little bit of math, right? And that's okay. I'm going to go through these. Carl and I are going to go through these with you. But it's talking about if you had a chance for higher returns, what would you do, right? What kind of decisions would you make? So this is where we get that classic risk tolerance questionnaire going. What amount are you looking to invest from the start? What amount should we put in here, Carl?
How about 10,000 to
Okay.
start with?
Okay. And again, this is whatever your answer is. So if you're taking this at home, if it's, hey, I'm going to start with $1,000, I'm going to start with $100 in that midterm bucket, be thinking about the bucket, right? I think that's also a good thing to think about when you
Mhm.
start this questionnaire. Be thinking about Clay and Carl are taking this because they're talking about the 2 to 10 year bucket, and I can see them answering the questions based on that bucket. That's really important. You might actually have a different risk score depending on your retirement bucket and depending on that short term bucket, right? Where we mentioned in the short term, you might have no risk, it might just be cash.
Well, that's a
Um,
great question in general, I guess, is should people think about it in those terms where, if they have long-term money, do you think that their risk score would be different than the shorter medium-term bucket?
yes, and I think about it in two different ways. So I'm glad we're kind of scratching at this. I like it when folks do one of two things. You're either taking the risk tolerance based on one of the three buckets, and you're consciously answering the questions based on that bucket. Now, in the next segment, you might see some questions that would be identically the same answers regardless of bucket. And so we'll get there. Or the other way to do it is you take one assessment just in general about your wealth in general. And then when you're blending the buckets together, short term, long term, in the midterm bucket, then you would average your stock exposure across all of them. So
Hmm.
one of the two is very effective. It's either risk tolerance per bucket, so that's three questionnaires, or you do one questionnaire and you average your three buckets together on how much you have in stocks. Like your short term bucket would be cash, so that's 100% out, but your retirement bucket might be pretty heavily invested. So you would add those numbers together to come up with your total.
Yeah, I love that. It reminds me of something that you said earlier on one of our episodes about the time horizon risk.
Yep.
And I think you used the example of your son who's 10,
Yep.
started with the number 100 and you subtracted his age and arrived at 90. And that was a rough thumbnail sketch of, hey, 90% of the funds available could be into the stock side of the market.
Yep. That is an excellent way to do a rule of thumb. And then this is going to even more fine tune that,
Yeah,
right?
that's great.
Yep. All right. So the first question here in the tolerance section is rate your willingness to take financial risk from 1 to 10. Notice there's no other numbers. There's no percentage gain numbers yet. This is really just trying to get a big 30,000 foot overlook on your comfort for risk. So thinking about the 2 to 10 year bucket, we wouldn't probably be a one or a two or a three, but maybe not quite so far out as a 10 for some people, right? Because that might be longer term bucket. So I would think somewhere in the middle here, Carl. What do you think we should pick for this midterm bucket?
Yeah, I think a middle of the road number, meaning that the higher up on the scale we go, the more financial risk we're willing to assume. Um, yeah, I think somewhere between the 4 and 7 sounds like a
Let's
good
go
place to
right in the
start.
middle with 5. Now, Carl and I are just openly talking about this. I encourage you to take it with your spouse, or maybe each spouse take one at the same time on two different laptops, significant others, right? Friends or family. Like, this is a good way to kind of bounce ideas and kind of see where you land. And this is one of the first questions that really is about your comfort. So, even though Carl and I are kind of picking 5, let's say, you might go, oh no, some of those first questions I felt uncomfortable with, and you're already telling me I'm at 63%, I'm not the person that's comfortable with risk. So if you are a 1 right now and you're thinking, wow, I never would have picked 5, I don't know why Clay and Carl are doing that. Please pick 1. We want you to pick something that's
Yeah,
comfortable for you. We're going to stick with 5 just to kind of stay focused on right this general idea of where maybe some people would land. But please definitely be picking answers that are most comfortable for you. All right, here's that first math question. Now, not lots of math, but I'll just kind of point out which of these outcomes would you be most comfortable with for your 10,000 investment. By the way, that number is not random. That is the number we put into the box, right? So it's trying to make it very personal for you. If you've started with 1,000, that's what's going to show up in this box, right? How
right.
comfortable are you, yeah, with that 1,000? And the reason why that's important is that it's going to give you these estimates, right, of this return. And so it's taking this 10,000 number that Carl and I put in by our own decision, and it's saying, hey, projected 5 years out on this answer right here, would you be comfortable making 25% return or $2,500? Notice as you go down with the answers, you're making more money on the projected 5 year earnings column. But
Mhm.
that's not what this question's really asking. I think it's asking, more importantly, what's
Mhm.
the worst case scenario that could happen? Everybody's going to say, Clay, I want to make $3,500. That would be so wonderful. But what I think the question's really getting at is, are you willing to stomach this $2,900 loss? And this is what, Carl, you had brought up a minute ago, which is that's where the panic starts. Nobody really kind of assesses the downside, right? On what happens and how am I going to choose what to do next? Because I think we all know once it drops $2,900, it's very hard to say, hey, I'm going to stick this out. A lot of people are going to say, man, oh, I'm just being beat up. I got to get out of this thing. And then when you sell it, that's when you locked in that loss, right? So this question is trying to get you to not have to have that panic moment and make that really rough decision, because once you sell, it's almost impossible to make that ground back up, right? Because now you're in cash, you withdrew the money, you're frustrated. I call it getting jaded, right? You became jaded with that result, and it's hard to get
You
over
may
that.
never go back.
That's right. I've seen that happen to folks, unfortunately.
Mhm.
So in this case, we're probably not going to necessarily pick. I think for this bucket, we might not be looking for the absolute biggest, gain here over that 5 year projected period. So, Carl, where do you think we should lean here with this design that we're doing?
Maybe we stay on that low side for now, and it would be
Yep.
interesting to go back and say, okay, instead of a 5, what did it look like? What does this chart look like at a 2?
Yeah. Yeah.
Because
Yeah.
there
Yeah.
may be people out there that are like, 20% loss. Are you out of your mind? Are you kidding? No,
Yeah.
I'm here. I'm trying to make money, right?
Yeah. Right.
And what does that
Yeah.
look like?
Yep. All
But
right.
I agree
So,
with you that this seems steering obviously to the downside, right? This is really that when we're analyzing the risk here of your tolerance, well, we're really kind of putting together the psychological impact of if you saw a statement and out of $10,000 you'd lost 2,100,
woo,
what is your behavior? What will you
that's right.
do
That's right.
at that
So,
point? Will you sell or will you say this is a low part of the market? I should double down and buy more?
yep. So, isn't it funny, Carl? You bring up a great point, right? Where it's not giving you a lot of like really great answers on this left side. It's pretty much having you, it's forcing you to pick. If
Mhm.
you're a more conservative person, you're thinking, I don't even want negative 21. I need something else here.
Right.
But let's pick that one because I want to show the viewers what happens next, right? So this is the part where our technology really kicks in. It's going to start after I click this button. You're going to see what happens on the next page, right? Which of these outcomes would be you be most comfortable with?
Ah,
So now it's starting to make very small adjustments, right? So now it's going to verify how far down are we willing to go? And if you answered negative 21 on the past question, I'm going to go back one screen. So we picked this negative 21, right? Now it's going to slightly reduce that again. And guess what? This is exactly what I said. What if
Mhm.
we're that person? What if negative 21 wasn't good enough and we wanted less loss? Well, then it's going to give us a little bit less. And guess what, Carl? You and I are going to pick this one and we're going to see what happens on the next question. Are you ready?
Great.
Okay. And then you see what it's doing is that it's just giving us a little bit less, right?
I
And what
love
it's
it.
trying to, yeah, I call this barbelling. It's trying to figure out, our system is trying to figure out what's your threshold? Like, where are you in a range?
Yeah, and at this stage, what's really interesting to me and fascinating is that the highest end on this page isn't even the 21% we started at.
That's right.
So
Yep.
that's very interesting. This is where the person, well, I'm willing to take some risk. Sure. Well, not that much. Well, not even that much.
Yep.
And it's interesting to watch it really kind of poke holes at the initial theory.
That's right. And so let's pick it one more time, right? We're going to pick the lowest end one more time. And notice
Hmm.
how it just lowered it 1% this time. It's just kind of barely shaving that.
Right?
But what if 16 was our limit? And we were like, yeah, I could be okay with 1600 on the loss, right? Once we answer this middle question, it should start to really then go, okay, we've kind of got down to where Clay and Carl are comfortable, right? Because you've said 16 twice. Once you
Gotcha.
kind of answer it a couple of times, we've now kind of got that range. So we're going to click that 16%. And then it ends the questions. Now it kind of knows where our comfort zone is. It starts with that negative 21, negative 18, negative 16. It gave us a shot at negative 15, but we kind of said, oh, 16 looks pretty good. And as Carl mentioned, it kind of brings down that maximum end as well, too. And kind of gives you that barbell, right, approach. All right. So isn't this interesting, Carl? What we scored in the risk tolerance is almost polar opposite to
Yep.
what our capacity for risk was. If you guys remember, 63%, right, was our capacity for risk, and 32% is our tolerance. And that's okay. Those things can be different. We can have capacity because we have knowledge, because we have a level of wealth, because we have time, but our tolerance might be less because of what we're trying to get these funds to do. Maybe it's the midterm bucket. Maybe it's just our comfort zone with losses, right? So we're already narrowing down where this risk, right? This risk level is going to be. So again, 32 means, hey, in your risk tolerance, maybe only 32% should be in stocks, but your capacity for risk, maybe 63% should be in stocks. So I'll show you how we're going to kind of reconcile these two things after this third step.
That's great.
But any questions here, Carl, from you, or any thoughts on risk
I
tolerance?
love how it really just interpolates all of the data to take on, it can easily, it seems like, separate the knowledge piece of the equation from the feeling piece of the behavior.
Yes, exactly. And if we like that feeling piece, I think we're going to like this last step. This is the newest part of how risk tolerance questionnaires have really evolved, is this risk composure. All right. So risk composure is the psychological measure, right? And if you've already thought, man, Clay, you've already got into my psyche the first two sections, so I can't wait to see where it goes on here. But you'll see these behavioral questions. And I challenge you to actually read the questions as I click on this, almost irrelevant of the financial world. And I know that's hard because we're taking it's kind of this podcast that I'm on with Carl with you right now is all about finances. So, but maybe take a step back from the financial part and just answer the questions through your eyes of your own psychological comfort with these questions. All right. I am easily stressed out. Again, if I just remove the financial part from that, this could just be in general in your life. Is that very untrue? I am easily stressed out. Is it somewhat true? Is it very true? Where are you at in this spectrum? So, Carl, for the just kind of where we're headed with this, where do you think we should pick here? I am easily stressed out.
Boy, I just love this first question because, it just makes me think back over time, right? From my 20s, my 30s, my 40s.
Yes,
And you
right.
think back and you go, well, a lot of this is really important because we may be investing, for our entire lives, but it doesn't mean that we're in the same place or in the same season for the investment world, let alone our own psyche. And I would say
Yep.
what a great opportunity this is to use this to double check something that maybe you've already, I just had this thought of, okay, you've got your 2 to 10 year bucket already in place and you find out you're in year 15. Hey, maybe it's time to reevaluate that and look at this as a tool to say, is this the appropriate thing for me at this stage?
Now. That's right. Yep. I love that. And I encourage people to take this once per year because life does change and it's hard
It
to
does.
bracket it. It's not just, I love how you said 20s, 30s, but a lot of times it changes just kind of randomly,
Mhm.
situationally. All right. So what do you think here, Carl? Should we put somewhat untrue?
I think somewhat untrue sounds like a great kind of
Yeah.
middle of the road ground for us to cover on it. And
Yeah. And you'll see these things have similarities. I rarely worry. So it's kind of that next step
Mhm.
versus being stressed out, right? This is maybe worrying about things. Stressed out, I think of as kind of the present, and worrying is sometimes more future. I think sometimes looking, but somewhat untrue. Do we just want to kind of stick with that?
Sure.
Okay. I remain calm under pressure. What do you think here, Carl?
I think somewhat true.
Somewhat
Might be
true.
a good
Yep.
middle of the road.
Yep. I am not easily disturbed by events. Now, you can obviously be reading these things and thinking about financial markets, right? And if your account drops precipitously, would that disturb you, right? That's a way to look at this. But it could be other events in your life, right? I am not easily disturbed by events.
I like the way that you color it when if you kind of remove yourself from the financial
Yeah,
piece for these questions, because this is really speaking to more you as an individual. How are you thinking about
that's
the
right.
world and interacting with things around you, and what level of, whether it's anxiety, nerves, or um, the things that are going to disturb you. This is such a great piece of the puzzle, and you can see where how you answer some of these questions may change this entire risk profile, right?
That's right. Yeah, because we've got
Um,
one that's already leaning into stocks and one that's balancing out. So this is definitely going to have an impact. I'm going to stick
yeah.
with somewhat. I'm going to stick with somewhat true here.
Okay.
All right. I do not worry about things that are out of my control. I'm going to put somewhat true. We're just going to kind of keep in that middle ground, right? Worrying
Okay.
about things, and that word worry. I am easily bothered. I'm going to kind of keep with that middle ground, right? Somewhat untrue.
Good.
I am relaxed most of the time. Most is that key word, right? Doesn't mean
Yes.
always. It's hard to be relaxed all the time, especially if you're driving on the freeway. All right. So I am relaxed most of the time. I'm going to put somewhat true. I keep my emotions under control. So we're going to stick with that, right? Somewhat true. We're going to put that kind of right in the middle. All right.
Perfect.
So here we got our score, right? Our risk composure score of 66. So it even says we're in the medium range, meaning that sometimes we become fearful in the face of financial uncertainty. But again, Carl, and I'm glad you mentioned it again earlier. I do counsel people take a step back from the financial world, but we're kind of stepping back into it now with the score, right? So it's okay. Sometimes people are like, oh, I feel bad saying these things, or I feel bad the way I answered it. We just want it to be real because that's how you get the best design because now we've got 3 scores, right? And we're going to click this button and we're going to kind of see how they all blend together, right? With these three scores here. So here we go. We've got capacity at 63, risk tolerance at 32, and composure at 66. So when we bring it all together, we've got that 3D risk profile score at 51. So it really does kind of help out, right? Iron out some of that risk tolerance part, that middle score. It helps us kind of bring down those 60s numbers down into that 51. So
I
again, to
agree.
kind of review that 51, right? It's really meant to say, hey, if Clay and Carl were designing this for the midterm bucket, 2 to 10 years, and we were kind of answering those questions with that in mind, we might feel comfortable starting off with a 51% or just about a 50-50 blend, right? 50% or so in stocks or in some sort of risk type investment. And
And
this would
this,
be, again, as I mentioned, a great place to start the conversation. Doesn't mean you have to hit it right on the dot. You could definitely tailor it to however you feel or what's going on in the current, situation of the markets. But this is a great way to kind of blend out capacity, composure, and then the classic tolerance part.
Yeah, I love this. And okay, so just to re-encapsulate in this example, of course, this is just this example. We
Yep.
had started this with $10,000.
Yep.
So if we wanted to boil this down to its most simplistic idea, we would basically be saying we're going to take $10,000 into this midterm bucket designed for 2 to 10 years, and 50% or 5,000 of the $10,000 we would be putting into, an equity market.
Yep.
And then where would the other 5,000 go, Clay?
Yep. The other 5,000 would go into bonds, right? Or fixed income, or even like a high yield, some version of a high yield account, right? I don't want to say savings, but maybe more of a high yield money market fund. I think
Okay,
could be a good, yeah, good alternative. Or Carl, there's also some really great tools out there that you can blend them both together in one tool, right? There's a lot of mutual funds out there.
sure.
If you see the word moderate in a mutual fund or the word balanced in a mutual fund, that might be worth exploring as well too in this example, right? Because we're blending bonds and stocks together to get some mix close to 50-50. And there are some funds out there, there are some tools that would be really great to use that you could just do it all in one shot.
Fantastic. I love it. And for all those out there that have either followed along or have listened with us, again, this is a great tool, and it should probably be done, take it with your significant other, your spouse. Um, Bounce it off even your children. I think this would be a fantastic tool for, if you have adult children, to go through the example with it because it's not forever.
That's
Um,
right.
this is one of those great scores where you can take this a couple of different ways and think about it in different, not only in different buckets, like we alluded to earlier, because I can imagine how these answers would have changed drastically for either one of us individually. Let's say if we were looking at a 40-year time horizon for this money, right? Or conversely, 1 year. As this moderated score that was blended, maybe an incredibly different number depending on what the thought of the money is in general. So,
That's
what a
right.
great tool. Thank you so much for sharing that with us.
Absolutely. And we'll put that link in there. So feel free if you want to use it or find another tool, but use a tool because sometimes when you just start thinking about it in your brain, it's still too emotional, right? But use something where you can get some good answers, objective answers, and that's a great place to kickstart.
Yeah, and I'd love to have people comment in the comments section below of after taking it to tell us what, your blended scores were, what they were individually, and how you felt about it, if that m made it up with your initial thoughts of maybe where you were going to be, before you took the assessment.
Yep.
Pretty cool. Okay, everybody, we will be back in just a moment with another amazing segment. Stand by.